Hey, everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend Jeff Santoro, the voice of the people. Hey, Jeff.
Hey, how are you?
I'm good. We're not going to banter much. We've got Ben Carlson with us here today. Ben is with Ritholtz Wealth Management and is the author of one of my favorite investing books, A Wealth of Common Sense. You thought I was going to talk about Ben, you thought I was going to mention the other book that you wrote about institutional investing, didn't you?
Yeah, not as many people read that one. It's kind of a smaller niche audience, but yeah.
Yeah. We're not going to talk about that one too much. We don't have a lot of institutional folks listening to our little podcast for individual investors, but Ben, welcome to the show. It's awesome to have you on.
Happy to be here, guys.
So Ben, one of the things we like to do when we have people on is give them a minute to just give their background, their origin story, how they landed, where they've landed in the world of investing. So give us some background.
I always like to tell people that if I tried to recreate my career path, it would be possible. That's why I hate giving people career advice, because I feel like so much of it is just timing and luck and circumstance. But I got into finance basically because I didn't know what I wanted to do with my life, and knew I wanted to work with numbers. I look back on it now. I hear these stories about people who grew up reading the Wall Street Journal or Barron's with their dad on the weekend or something, and they pick stocks. That was not me. I didn't know anything about the markets until I got an internship working for a sell-side analyst in college. I thought, oh, this is kind of interesting. I like the markets. I like studying these companies. And then out of school, I got a job with an institutional consulting firm, and we were managing money for pensions, endowments, and foundations. And it was a smaller firm, so it was kind of good because I got to really get my hands dirty and understand a lot of what it takes to manage money for a big institution. And it was interesting because we managed money for families and institutions. And the big thing I took away from that job was I assumed, well, investing is stock picking. Right? Everyone is like Warren Buffett. You pick the best stocks. That's how you invest. But what I learned early on is, no, the way that you invest with an investment plan is you have guidelines and you have an asset allocation and you have all these different moving pieces and you want them to work together. You want complements and you want diversification and all these things. So I learned very early in my career that, that security selection is important. But if you want to actually, manage money within the construct of investment plan, you have to have all these other pieces, and security selection is just one of them. So asset allocation was something that was really drilled into me early on. It's the different types of asset classes and strategies you use. So I kind of worked my way through the institutional world and went from managing money for a handful of different institutions to just one. And I worked for an investment office for 10 years or so, managing money for $1 billion cancer research institute, actually. And then was just kind of getting bored. And I think the defining moment of my career was really just living through the great financial crisis and seeing how that changed people's thoughts and behaviors and actions to the markets. And here I am, pretty young and green in the industry, and I see the stock market's down almost 60%. Mm-hmm. And I'm thinking, listen, I've never experienced anything like this, but I've read all these history books. I've be greedy when others are fearful and fearful when others are greedy. I've read all this stuff and I'm thinking, this is amazing. This is like a once in a lifetime buying opportunity, and everyone in the institutional world was going, no way, we're in the fetal position. We're trying to save our jobs. It's career risk here. If this thing really falls off the edge of a cliff and the financial system goes under, like some people were thinking at the time, we gotta protect our backside here. And everyone got really defensive. And I feel like that whole, just watching that play out, and a lot of the people I had these conversations with at the time were saying, listen, I understand where you're coming from, but this is our livelihood here. We have to protect what we're doing. And so everyone got defensive, and that really kind of changed the way that I viewed that world. Like, oh, it's not just, fundamentals and here's what we think about the markets, and it's behavior and it's career risk and all these other incentive structures that move things. And that's when I decided I need to start sharing some of my thoughts. So I was kind of just didn't feel like I fit into that world anymore because everyone was doing things differently than me. And so I started a blog to kind of share my thoughts. And that's, fast forward a little bit, writing that blog helped me gain an audience and get to know the people who started Ritholtz Wealth, which was at first Josh Brown and Barry Ritholtz. Mm-hmm. And that's kind of how I came to work with them, is by producing content.
Ben, do you think if you were one of the more established older guys when the great financial crisis happened, you would have thought about it differently? Do you think the way you saw it was a little bit of the benefit of being younger and newer in the industry?
Yes. I think a lot of this stuff is based on your experience and timing and, like I said, luck. And I think just maybe because I was almost naive in so many ways, I didn't have these past experiences to shape me. And I do think, yeah. Again, a lot of people I saw just come out of that situation so much more defensive and bearish, and people thought, that was the financial crisis is where a place like Zero Hedge comes from, right?
Yeah, right.
We lived through one of the longest bull markets in history, but all these people latch on to like the doomer and negative, and maybe part of it is just personality too. I've always been kind of a glass half full kind of person, just by disposition. But yeah, I think you're right. That experience, the timing of it can be helpful or hurtful depending on where you're coming from.
The one thing that I've learned, because similar to you, I kind of started getting involved in this around the financial crisis and jumped into it full time as a writer and investor in 2011, 2012. But like investing through that time at the beginning of my career and having kind of the basic understanding of, based on your time horizons, downside volatility is really an opportunity, right? It's not a risk if you're allocated appropriately based on your goals. So I was the same thing, really kind of fortunate from that perspective. And my question for you, coming through that kind of that period, the bull run that we've gone through with stocks, the core of that is economic growth, right? Companies are so much more profitable than they were 15 years ago, especially some of the biggest, most global companies. We know interest rates played a big role in the access to capital for so many of these businesses over that period. At the same time, devalued bonds and diversification. So one of the things you were talking about at the beginning there is the idea of when you're building an investing plan for an investor, having kind of almost like rules where you have an allocation plan that you're following along with and that you're trying to work within those frameworks and those guidelines. How much talking to individual retail investors out there, how much has been lost, the idea of asset allocation over the past 15, or really you could go back 20 years, where stocks have kind of become the only game in town, but that's not true anymore. But I mean, there's hundreds of billions of dollars in brokerage accounts right now that's not properly allocated for a lot of people.
Yeah. And getting back to the experience and timing thing, I lived through that lost decade, bookended by two huge crashes from 2000 to 2009. The S&P 500 went nowhere. And coming out of that, you mentioned getting in like 2010, 2011, 2012. That was the period where people were saying, listen, you have to invest in the bricks. It's emerging markets. That's where the growth is going to be. No one was pounding the table like this is going to be one of the great bull runs in large cap U.S. stocks that we've ever seen. No one was saying that back then.
Right.
And I think you mentioned the tech stocks being so profitable and having such high margins. That was obviously part of it. But I think another reason that the tech stock that the U.S. did so well is because it did so poorly in that first decade of this century. That shaped me too, because I saw all these other areas of the market, bonds and foreign stocks and emerging markets and value stocks and small caps, mid caps, all these other areas of the market did really well when the U.S. did poorly. And so that made me realize like risk management is a huge part of this if you want to survive. Now it's funny, people who came in later, they think, well, why would I ever do that? Why wouldn't I put all my money into U.S. large cap growth stocks? They're the only thing that work. And not just the S&P. I'm going to go in the NASDAQ 100 where I'm just going to buy these 10 biggest stocks. And why would I ever
concentrate down? Yeah.
Yeah. Why would I ever invest in anything else? And if you did that for the last 10 or 15 years, you made out like a bandit and you did awesome. And anyone who was diversified looks at part of their portfolio and goes, what was I thinking here? Why would I ever invest in any of this stuff? And there's this great saying from my friend Brian Portnoy. He says that being diversified means always saying you're sorry about something. And so I think investing itself is a series of trade-offs. And I think you have to go through like the regret minimization framework of which trade-offs am I comfortable with? And so some people, I think if people like do go all in on the S&P 500 or any area, pick one, value stocks, small caps, micro caps, whatever it is, anytime you go all in on something like that, you just have to go in with your eyes wide open to when it's going well, it's going to be going really well. And when it's going poorly, it's going to really stink.
And you have to own that though, right? You have to acknowledge this is an active decision that I've made to forego reducing exposure to things that could minimize the.
And if you're going to do that, you can't just choose to follow it when it feels good, right? You can't get out of it when it's not working because, well, I didn't sign up for this. Like that's the whole point, is that you have to stick with whatever you're sticking with. Otherwise it's not going to work.
So that's a good segue into the next thing I wanted to ask about, which is, so obviously you work in an industry where you help manage other people's wealth and help them make these decisions, right? Guide people through this process, everything we're talking about now. So who is the ideal candidate to work with a wealth manager, just generally? Like because we are Jason and I are individual investors who kind of DIY everything. And I think my guess is a lot of our listeners are in that same boat, just interested in this. But who do you think is the ideal candidate to like actually take the time to go work with a wealth manager?
So there's a handful of people come to us who want to work with a financial advisor. And I should say right off the bat, I'm not myself a financial advisor. I'm on an investment committee and I work with our financial advisors, but we have client-facing advisors that handle that, CFPs, and they're not just handling portfolios, they're handling building financial plans and insurance and taxes and estate planning and all these other things that matter to people. So there's a few reasons. One is a life event, and that could be a marriage or a death, or you're buying a house or you sold a business. Something in your life happens and you go, oh, wow, I really need to talk to someone about this. This is a big decision. I don't want to mess this up. An inheritance, something like that. Another one is just your finances are getting too complex, or you don't have the time or inclination. You just want to outsource, right? You're too busy and you realize, like, I need someone who's going to pay attention to this. I'm going to give them the steering wheel. I don't want to drive anymore. I think there's a few people who have made mistakes who just realize, like, I need someone else to do this. But you mentioned the DIY thing. That's one of the growing areas for us. And I'll tell you, it's hard for a person in that situation to just hand the keys over and go, here, take it, because they've done it themselves and they've studied this stuff. And there's a lot of people who follow us who say, I have done this myself. Look at how successful I am. I built up this great portfolio. Why do I need you? But what happens is, especially as people get close to retirement, it's the key person risk. And they go, listen, because usually with a married couple, it'll be one person who's managing the finances. Not always, but we get that a lot. And they say, well, what if I stepped off the curb tomorrow and a bus hit me? And what happens to my spouse or my children or my grandchildren or whatever? Are they going to be okay? Because I've been the one managing the finances. And we all know people who have a relationship where one person just doesn't know as much about what's going on. We get that a lot, where we have someone come to us and say, like, listen, I've done fine with the investments. I've saved. I built a great portfolio in Nest Egg, but I just don't want to, if something, God forbid, should happen to me, I want this to be okay and have someone else there to make sure my family's taken care of. So we get that a lot. So I think those are the biggest ones for us.
One of the things that I've come to acknowledge after a pretty decent amount of success over the past 15 years, and I first read this and it's absolutely spot on. Nick Majuli, Nick, works at Ritholtz Wealth, for those that don't know, chief operating officer, I believe.
Yep.
For a while there, he tweeted this out pretty regularly. And it was just the point that so many people that start to get really passionate and interested in investing would probably be better suited, and directionally, this is what he was saying, would be better suited at focusing on their careers and focusing on growing their earnings, because you could only outperform so much. You can only get so much outperform where it's worth, a meaningful amount of wealth at the end of whatever that journey is. And it gets kind of back to the money value of your time, right? So is that an area where you think maybe the average person probably would be smarter to think about working with an investment professional?
Yeah.
And spend more of their time trying to earn more money?
Yeah. And one of the things that our advisors try to help clients do is define your goals. And part of that is, like, what do you want to spend your money on? Right. And that's one of the hardest things people have. Like, if you've spent 30 or 40 years going into retirement, building up your nest egg and saving and making retirement contributions and making good investments and making wise decisions and living below your means, right? You're delaying gratification, just flipping a switch and then being like, all right, I'm going to spend it all. That is really hard for people. And a lot of people need permission to actually spend the money. We all the time run into people who say, I don't want to spend anything. I'm going to never touch the principal. I'm going to live off the interest or dividends or whatever it is and the income. And we kind of have to have a conversation with them going, no, wait, what was the point of building this wealth in the first place? We want you to enjoy it. You have enough money, go buy that vacation home, go buy that convertible, buy the boat, take the trip with your family, whatever it is, as long as it is within the means of your financial plan and we've run the numbers and it makes sense, like, have at it, like, or give some of it away or whatever, help your children out, give it to charity, whatever it is. So that's one of those things too, where people just need permission sometimes. But yeah, you're right. The timing component is a big one, and the outsourcing too. If you work in another field, maybe your time is better spent doing that work as opposed to constantly paying attention to your brokerage account or your stocks or whatever.
All right. So I know this is counterintuitive to talk in your own book, but who shouldn't use a wealth manager?
Let's flip this over. Yeah, let's invert it.
Yeah. Well, like I said, there's plenty of DIY people who enjoy this stuff because we put out a lot of financial content. We know that there's plenty of people who come to us and they study this stuff. And a lot of times they're giving me feedback and saying, well, have you ever thought about this? Or did you know this? And there's certain people who they really get enjoyment out of this. And if you do, and you study this stuff and you know what you're doing, do you need a financial advisor? No, of course not. I think there's also a lot of people who are still coming up and are younger or middle-aged who just have their saving and investing on autopilot, which is easier than ever to do these days. Yeah. And if you're just doing that, you don't have a lot of complexities in your financial life, you don't have a lot of questions for someone, you really need an advisor to check in on you once a year and say, hey, are you still saving? Yeah. Okay, good. Those people are fine. So I think a lot. We tell people all the time, having an advisor isn't for everyone. And some people just never get to that point where they think they want or need one. I personally have an advisor. Someone at our firm helps me as my own financial advisor, because for me, it's about bouncing decisions off of them. If I have a big decision and I need to know, what do you think about this? And so I think having an objective third party is helpful, but some people, frankly, don't need that.
Yeah, that makes sense.
But then you get the employee discount though. So
This is true. That helps.
He gives you advice, you give him advice. It evens out. Yeah.
Yeah.
So one of the things that we have kind of been forced to talk about a lot, Jason and I, over the last couple of months, is just everything going on in the world generally, and then also how it impacts markets and investments and things like that. So,
Jeff, who are you kidding, dude? We love talking about chaos.
Well, I'm curious though, like for your particular job, Ben, at Ritholtz, how much do you have to factor in what's going on in the macro economy when you're making decisions or advising people? I mean, because now is a particularly chaotic time.
Yeah, I think telling people to ignore the noise is a great soundbite from financial advisors, and it's completely useless.
Yeah.
Right.
Yeah.
It sounds awesome, right? Just ignore the noise. Don't worry. You can't ignore the noise when we live in a world of smartphones and constant alerts and 24/7 news cycles. And I think if you're constantly telling your clients, hey, just don't pay attention to this, right? Don't look at what everyone else is looking at. Just, you'll be fine. I think that sounds great in theory. There's maybe a handful of people who can do it. Most people can't, and they need context and perspective. And that's one of the reasons that we built our business around content and helping people, because we don't want people to constantly have to call their financial advisor and go, what do you think about this? Well, rates are higher, inflation is lower, or look at what the president said, or, look what markets are doing. What do you think? And so that's why we produce an excessive amount of content. Some would say too much, because we want people to understand what's going on. And I guess the way that we look at it is, I'm a big proponent of studying market history to understand human behavior and how markets tend to generally react over time. But I think you also have to use the present situation to sort of put that history into context and perspective. Not that it's going to help you predict the future any better, but I think if you don't understand what's going on in the present, and it's going to be hard to make reasonable decisions about the future.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brent.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Well, it helps you operate in the present, I think, is the big thing for me, because we don't know what's going to happen in the near term, but we do have history as a guide that tells us that as long as we do the things you've talked about, thinking about your long-term and short-term goals and building an asset allocation around those things first, it's going to work out with some, like, directionally, it's going to work out along the lines of what we were trying to get to. But I'll tell you, Ben, I've been a subscriber to A Wealth of Common Sense, the blog, and it's up here somewhere behind me, the book too. And it's one of the things I want to say that I think is interesting is it's not the regular stuff you put out multiple times a week. For somebody that's been, in the industry investing for a long time, there's nothing necessarily revelatory anymore, but it's daily affirmations, you could almost say. And I think that sort of thing is so important because it definitely helps people stay grounded, because we're always going to be looking for an edge. We're always going to be looking to avoid the downside because it hurts more than the upside feels good.
No one goes to church on Sunday expecting to hear the 11th commandment, right? You're going there because, and I think the affirmations are partly for me selfishly. I need to keep myself because I think we live in a double-edged sword world as investors. Like there's never been a better time to be an individual investor. You have access to, there's free trades now. You're not paying these huge bid-ask spreads, right? In the past, you were paying, 2 or 3% to put a trade on. For mutual funds, you were paying like a 10% front-end load to put your money in. Now we have ETFs that are more tax efficient. You can invest in all these niche strategies that investors 20 years ago would have killed themselves to have access to. The downside of that is that there's never been more temptation to make changes all the time.
Yeah.
Right. Yeah. Well, why didn't I invest in this? And what about this new strategy? Oh, there's a new ETF that does this. And oh, look at the stock just IPO today. And there's all this stuff. And I think that's part of the hard part about being an investor is like just sticking with a good strategy. I think if you look at Buffett's track record, one of the best things he ever did was just he kind of stuck to his knitting. And obviously he's evolved over the years, but he more or less stuck to his same investing style year in and year out, even when it wasn't working. And I think that's the hard part for people these days is just hell or high water. Can I stick with this strategy? And it's not easy these days.
Yeah, I like what you said about telling people to ignore the noise is sort of not worth it because it's impossible. But I like the idea.
Listen, I've done that before. I'm guilty.
Oh, we have too. Yeah.
Yeah, it doesn't work.
But I think what I like is the idea of helping people think about how to think about the noise, right? You can't ignore it, but you can kind of train yourself to think about it differently. And I know when I was I'm going to say newer stock investor, I've been an investor my entire adult life, but I never really paid attention to it, which actually gave me the confidence to trust that things will work out in the end because I did kind of make it through the great financial crisis and I still have a retirement account. But the idea of finding out learning how to think about the noise can be super helpful because you mentioned like studying markets and knowing the history. I know it feels a lot better when the market drops 30% to know that it's dropped 30% before and come back from it. There's just one example, but there's little nuggets of historical information all along. Any market thing that happens, you can usually find some sort of historical parallel and look at what happened after it to help you think about what's going on in the world. So let me drill down a little bit more specifically into like probably the second biggest thing everyone's talking about other than just the macro environment and tariffs and things like that. And that's AI. We've been debating back and forth for over a year now, if it's a bubble, if it's not, if it's just the normal cycle of when new things come around in investing. So I'm just curious where you're thinking we are in this, whatever you want to call it, AI paradigm or however you want to think of it.
My favorite history to study is the booms and the busts, because I think that just gives you a range of potential outcomes. And the thing that I've seen over and over again, going back to every piece of new technology, automobiles and trains and railways and the internet and all these things. And every time we've had a new technology like this or an innovation, it always leads to a bubble. And so if AI is really going to be as big as the technology people tell us it's going to be, it would be shocking to me if it didn't lead to a bubble at some point, a boom.
Yeah.
Right. And some people say maybe it already has. I don't know. We had an IPO last week for CoreWeave that's it priced below where they thought it was going to be. So people are obviously worried about other stuff right now, but I was kind of shocked that happened. So again, if it's going to be as big as they say it's going to be, and all this money is pouring in and it's really going to change the world. It's going to change the labor market. It's hard for me to imagine a world in which that doesn't lead to some sort of boom because of human nature. People always extrapolate the present into the future endlessly with these things. And even if things work out as good as advertised, it always, like the .com boom, I think everything and anything we wanted and more from the late 1990s has occurred, right? If you would have told people, listen, you're going to get Spotify and YouTube and Zoom calls and all these wonderful things, they would have gone, yes, this is what we want. But you still had to go through the .com bubble blowing up first. So there's things that have never happened before that happen all the time in the markets, I like to say. Like, oh, that never happened before. Look, it just happened. So it certainly could be that way. But if we're all going to have our own AI assistants, and, my kids are going to have an AI tutor someday, and it's going to make our lives easier, and it's going to change the labor force and restructure the way that things are done, it's hard to see it not being some sort of massive boom. And sometimes it's funny because you're right. We're paying attention to all this macro stuff right now in tariffs. And part of me wonders, for the second half of this decade, is AI the only thing that's really going to matter though to the markets?
Yeah.
Right? We're paying attention to the short-term stuff, but if it really is as big as they say it's going to be, maybe that's the only thing that matters. And I don't know where it goes from here.
So how do you think about investing in it though? Because like I think that's the hard thing. If you're interested in this, or or you're a do-it-yourself kind of guy, and you're thinking about, all right, this is the big thing. I do believe in the future of it, right? Even if we think there might be a bubble happening now or in the future, like I don't know, that's where I land. Like, do I think there will be more AI stuff in a decade? Yes, I do. But the hard thing is like, what do I do with this month's money I'm going to put into the market as it pertains to AI, right? Do I stay, and I'm not asking you to give me advice, I'm using myself as an example. Do I stay away from the AI quote unquote companies because I do think it's a bubble? Do I buy a little over time and sort of DCA into it? Like, you're helping people make financial decisions and advising and things like that. Like, do you have to think differently about how to do that because we may be in or approaching a bubble?
Ben, before you answer that, Ben, I just want to put one more layer on that. I've been thinking more about this, even from the perspective of just an indexer. If I'm just indexing into a S&P 500 index fund, directionally 40% of my investments are going towards companies that AI is a big part of the upside and the downside. So even thinking about it from that perspective, it seems like AI is so weighted into the average person's investing, even if they don't necessarily realize it.
Right. I think if you're looking at it from like, who are the winners going to be? If you're looking at it from that side of the things, then I do think the market will probably pick the winners for you. So an S&P 500, even like a NASDAQ 100 index fund or ETF, if you wanted to like drill down even more, I just don't see how you can. The biggest AI company could be a company that we're not even thinking of right now, and it's not even on his radar. If you look back at the top 10 for the S&P 500, NVIDIA wasn't even there in 2020, and now it's the first or second biggest company in the world, depending on the day you're looking at it. So from that perspective, it's obviously much harder to pick the winners ahead of time. So I do think the market will pick the winners for you. But Jeff, to your point about like, what about the downside? If there is a bubble and then it turns into a bust, I do think that's when diversification comes in handy, because we've already seen it this year. Those Mag 7 stocks have all crashed pretty hard. They're all down, besides Apple right now, they're all down more than 20%, from their highs.
Mm-hmm.
And some of them are down 30, 40, 50%. I think Tesla's down 50%. So you could, but the rest of the market is holding up okay. Higher quality stocks, dividend stocks, small caps, international stocks have had a pretty good year. So I do think that's when diversification comes in handy, because the tech stocks have been the only thing that have worked, as we talked about earlier. But a lot of these other areas don't have a lot of tech exposure. So I do think that's when diversification becomes your friend, is when, if there is another side to this and it does, stumble, and we realize like, oh, these Mag 7 stocks have put so much money into AI, they're not going to see returns on this for a decade. We thought it was going to happen immediately. Then I think these other areas of the market aren't going to be harmed as much. And it's kind of a situation like the lost decade where, these other areas kind of can cover you a little bit, as if those stocks lag.
Well, I think I think everybody's lens is also shaded by the 14 to 15% annualized returns we've gotten over the past 15 years. And maybe part of it is just we all have bad expectations in that regard as well, in terms of thinking about what an acceptable rate of return should be going forward versus driving by looking in the rearview mirror a little bit, so to speak.
Yeah. And that's working in wealth management. We think that's one of our biggest roles, is just setting realistic expectations for people.
Yeah.
And that means after a year like 2020 and 2024, where you had like back-to-back years of 20, 25% gains in the S&P, just reminding people like, this is not how it's always going to be. This is not, those big gains are kind of normal, but not every single year. You have to expect that at some point the averages work themselves out, where a big up year is followed by a down year, and that's okay. And so you can't expect to just have these wonderful gains all the time. It's not going to be, because setting those expectations is really important, that you just don't get too far ahead of yourself.
Yeah. And it's funny. It ties exactly back to the conversation we were having a few minutes ago about how to think about the noise and what everyone's talking about. Because the reason we end up talking so much about AI is because that's the question everyone's asking. How do I get in on this? How do I get the gains that NVIDIA saw over the past couple of years, not, the last few months notwithstanding? And I think I love that idea about the way you think about that noise is to look at your diversification and find some other places to put some of your money so that you're not so exposed if we do hit a bust. So you've been doing this for a long time professionally. I'm just curious, and I like to ask this question of anyone who works in this industry as a professional. Has working as a wealth manager like changed the way you invest personally? in a lot of ways? Or do you feel like constitutionally you're kind of the same investor you were before you got into it professionally?
Well, that's a good question. It certainly changes the way I feel about investor behavior, working with all sorts of different people from different backgrounds, and they made their money in different ways. And I think what I've learned is that there's a lot of different ways to succeed as an investor, right? I've interacted with people who made money in real estate and private equity and venture capital and bogleheads who just saved money in index funds and stock pickers. We get these statements from people who say, I bought this stock in 1986 at the IPO and it was 86 cents on a split adjusted basis. And here's my cost, here's my market value now. And so I've seen all these different ways to succeed. So I don't think that there's just one way to succeed as an investor. I think the people that think that way are pretty close-minded, but I think there's only a few ways to fail and make mistakes. And so I think for a lot of people, it's trying to avoid those landmines and not making a big mistake at the worst possible time. So I think that's part of it for me. It's not so much that I'm even worried about the downside as much as that I just don't want to make a big mistake at the worst possible time. And I want to, as much as I can, stay out of my own way. Because I know the people who tinker too much and try too hard, I always say that there's no extra points awarded for degree of difficulty when investing. Right. Jason Zweig has this great story where he went down and interviewed a bunch of retirees in Florida a number of years ago and kind of asked all these people, how did you retire? And he got all these different answers from people. And he asked one guy, did you outperform the S&P 500 through your retirement savings over 40 years or whatever? And the guy said, I don't know. And I don't really care. Either way, I ended up in Boca. So what does it matter? And so that's part of it too, is just knowing that, like, as long as I'm on track to reach my goals, that's the only benchmark that matters.
Yeah, that's exactly right. One of the things I try to remind people of is exactly that. If you're buying stocks and you're picking winners, it's a good aspiration to try to outperform the market, but your goals should be the things that you're trying to do in the real world with the proceeds of that, right? Keeping that as the North Star matters so much. But circling back to the conversation, the topic we were just talking about, one thing that you wrote recently that I thought was important and just so cogent in this moment is talking to hundreds of people that have created wealth over their careers. You haven't had a lot of conversations with people that made their money calling the top or the bottom, right? Timing the market. It seems like that's the trap that people fall for. And we're always trying to find that edge, like I said before. But it reminds me of something that Morgan Housel wrote a number of years ago. And he used tennis as the example and talking about the difference between highly skilled amateur tennis players compared to professionals who maybe don't really have a lot of additional physical skill. And the difference is unforced errors, right? The ability to not force the mistakes. How much do you think about, you kind of hinted at it, but how much do you think about that concept as being kind of the core of being successful as an investor?
Yeah, I always tell people that if you look at the last 100 years, the US stock market is up, call it 10% per year. That includes all the bad stuff too. Yeah. That includes the Great Depression and the inflation of the 1970s and the 1987 crash and the Great Financial Crisis and all the bad stuff. It's not just like, hey, the good times, that's what you get, right? It's the bad stuff too. But I've seen the psychological mind games that market timing can do to a person. And we talk to so many investors in 2015, 2016, and they say, I got out in 2008. I remember one guy who said, I got out right before Lehman imploded. And it was the greatest trade of my life. I got out that Friday. Monday, Lehman Brothers goes under. And guess what? I've been in cash ever since.
Yeah.
And the market went up and I feel paralyzed. I'm addicted to this cash that's earning nothing. That was back when rates were still zero. And he said, but what if I put all my money in and then the stock market rolls over again and it crashes? I want to wait for the next crash to happen. And of course it never happened. And we had so many conversations like that with people. And I always say that market timing requires being right twice, right? When you get out and then when you get back in. And the getting back in is the really hard part because that cash becomes like your comfort blanket, right? Like it makes you feel good that you have it there. And then you say, well, I'll just buy back in when stocks fall 10%. Then you go, they fall 10%. You go, well, no, I'll wait till 20%. And there's never a good time to get back in. And that's the hardest part for people. And that's why I think it's so challenging. It's not necessarily, you could put some rules on it, I guess. And I know people who use trend following strategies and there are ways to change your allocation if you want it or need it. But short of that, if you're using your emotions, and it's a really tough game to play. There's just so much brain damage involved that I think it's not worth it to keep trying.
Ben, you use charts and you'll put that asset quilt and different things in your posts every once in a while to kind of reset how different things have done and kind of reframe the way we should be thinking about things. And there's one chart that I like to pull that I've been pulling for a long time, going back to the second week of March in 2009, that was the bottom, and looking at it, it's like, here's how the market's done since then. And then I go back to the week of, I think it was the first week of October 7th, I believe, of 2007, which was, I think, for most investors, the worst time you could have bought stocks, because it was 5.5 years before the market fully recovered. But you mentioned that average, that 10% number is, yeah, sure. From the bottom, catching that bottom, we've like 15, 16% annualized return since then. It's just been exceptionally good. But even from the stupidest, worst, boneheaded time to have bought stocks, for most of the people that are going to be listening to this, you've gotten 10% a year on average over the past 18 years. Since that 17.5 years since that date. So that is always just such a good reframing to recenter because everything you were talking about falling in love with cash, it's so easy to do. So especially now when we're actually getting some yield on that cash.
Yeah.
Are there any things that you specifically do to help you stay focused?
Well, I mean, it's really boring, but the thing I always tell people is I love looking at those studies from like, this is the return from the top, or this is the return from the bottom. And you can pick these, with hindsight, it's easy to pick out these points and make your numbers look really, and sometimes they're cherry picked and sometimes it's just fun to have fun with numbers. But most people don't take a lump sum of money and put it in all at the best or the worst time.
Right. Exactly.
Most people are, because of the way that they save, they're putting money in on a monthly basis or a quarterly basis or maybe a weekly or biweekly basis, because that's when they get paid and that's when they have money to save and invest, and they automate it. And I do think that's one of the ways to get around that idea of worrying about the Murphy's Law. And people think like, oh, if I put all my money in now, it's the worst thing that's going to happen. Is that if it's almost like a way to diversify across time and environment if you're just constantly buying at different intervals, right? And I think that is a way to think about it. And especially when you're buying, when stocks are down, I think having that sort of automated mechanism so you don't have to think about it and you don't have to react in time. It just happens, because that's when your best purchases are going to come, right? When stocks are getting hammered,
which is the hardest time usually to pull the trigger and do it.
Yes. So I think if you can have it automated, I think that's one of the best things. One of the favorite things for personal finance experts to say is getting your finances in order is just like you're getting your health in order, right? Everyone knows what they have to do, but it's hard. So getting your health in order requires you to work out regularly and then eat healthy. But every time you try to do that requires a choice, like going to the gym or going for a jog or a walk. Like you have to actually like get out and do it. And the same thing with food. You have to choose to eat right for every meal. With investing, sure, you have to make these choices, but you can make those good decisions ahead of time. You can automate them and say, rebalance for me once every year or once every 2 years or once every 6 months. Automatically hit a button on your computer and you walk away and you're done. I want to buy in my Roth IRA once every month. Done. And you can extract yourself from the equation. And I think that part is one of the better innovations we've seen technologically over the years, is just the ability to take yourself out of the equation if you know that you have a problem tinkering. Yeah. Some people can handle it better than others, but if you know you have problems with it, just keep yourself get out of your own way, right?
It's interesting too, because there's a perfect example for anyone who has a 401k or anything like that, because that's how that works, right? Like you said, every 2 weeks you get paid, the money comes out of your paycheck. It's buying that day, regardless of if the market's up or down. Like the day the money hits the account, boom, it's executing. And that was a huge help for me, being like an investor in a retirement account for 20 plus years before I ever got into or interested in buying an individual stock, as an example, is that I had that 20 plus year lesson of, look what happens when I don't ever think about when I buy, right? Because I can look at my retirement accounts and my wife's retirement accounts, and they're fine. They're higher than they were a decade ago and higher than they were 20 years ago. And that helped me sort of personally settle into the idea of dollar cost averaging, or not worrying about timing the market, or buying twice a month or once a month, whatever it is, and not anchoring on the price too much. And I just think it's interesting that it just goes to show you how hard the psychological thing is, because that really shouldn't be a struggle, because we all have this example, or any of us who have retirement accounts have this example of like, well, look, it works. You've been doing it for decades, and it's right there as an example. But that's
why I think having like those offsets where you have in your brokerage account, you're picking stocks and you're buying options and you're trading crypto, whatever it is, to scratch the itch. But then over here in your retirement accounts, it's kind of an autopilot. I think having those things to compare to one another just make, every once in a while, I'll be like, this account that's just, I'm not doing anything to it, and it's crushing my brokerage. Like, what am I doing here?
Yeah.
And so over the years, I've slowly but surely like simplified even my brokerage account and have that more automated. And I still pick stocks. I still have fun with it, but I think it's good to have like a benchmark to yourself to be like, can I really do better than this over here? And frankly, following along at this stuff like you guys, to me, it's interesting. And so even if my stock picks over the long term don't quite beat the market, I'm okay with it because it's interesting to follow these stocks and follow trends and these sorts of things, right? Obviously, you want to do well with your investments, but I think for some people just like to be part of the game and be in it. But I look when I do try to like, I put a lump sum into my brokerage account, and instead of just investing it right away, I try to get cute with it. That's when I realized like, well, why did I do that? Why didn't I just do what I'm doing in my other accounts? And it's a good reminder to yourself, like how hard it really can be to like, oh, well, what if I just wait a month to then deploy it? I can find a better entry point, and then the market gets away from you. And so, yeah, it's a good constant reminder how hard it is to really beat the market.
Unforced errors. They creep in.
Yeah,
absolutely do.
So Ben, let's dive in a little deeper what you just said. Like, what kind of personal investor are you? Are you most at this point in your life? Are you mostly in automated things like index funds and ETFs? Like, what percentage are stocks? I'm just curious, like how you think about that for your personal portfolio.
Yeah, I'm pretty boring. I've the whole ethos of buy and hold attached to me very quickly. When I'm, I came up and learned before there was blogs and podcasts and stuff. So I was reading the books, and every book I read, I do think a lot of it is personality based. That just made sense to me.
Mm-hmm.
The whole buy and hold and keep buying and keep holding. So yeah, it's mostly index funds. I invest in a lot of stuff that our clients invest in, but it's long-term models. And I do practice what I preach in terms of diversification. So I diversify across geography and strategy and market cap and all these different things. And so yeah, I'm pretty boring, set it and forget it investor. But yeah, I do have a brokerage account where I pick some stocks, and I own some Bitcoin and some of these things that I just kind of find interesting. But 80% of my money is that's liquid is invested in the stock market, and I kind of buy and hold and let it do its thing. I have more faith in the market than I do in most institutions these days. So I kind of let the stock market do its thing.
Yeah, Jason and I are the same in the buy and hold and sense. I'm kind of in percentage wise same as you. Like I only about 15% of my invested money is in individual stocks, where I do try to beat the market just because I'm intellectually challenged by trying to do that. But because 75% of my money is just in index funds, I don't really have to worry about sinking my future if I'm really bad at it. But yeah, I was just curious where you were with that.
Yeah, I'm Ben. I own over 90 individual stocks, so I'm one of those people that drives you bonkers. It's fun though. It's the scratching the intellectual curiosity itch is a big part of why I've kind of fallen into this pursuit.
I think the stock market is the greatest game that there is. It's endlessly fascinating, I think.
Yeah. No, I absolutely agree with that. Ben, let's do the lightning round here and wrap things up. And I have a bonus question that we didn't send to you that I wanted to ask you. So I think you're a brilliant financial mind and like a bedrock follow for people that are trying to DIY this thing. But when your family became a boat family, it started to erode the foundations of everything that I thought I believed in you. So my question is a prediction. Will the returns that you get from Bitcoin offset the cost of owning and maintaining a boat for the rest of your life?
Nothing offsets owning a boat.
Yeah, probably not.
Probably. Yeah.
It's a hole in the water you throw money into.
Yes. So you mentioned, you said, have I changed much as an investor over time? Probably not all that much, a little bit, but I think I've kind of held true to the same philosophy probably for the last 20 plus years. My biggest change has been personal finance wise, where when I came up, I was always, and a part of it was drilled into me from my parents of being frugal. And my dad always talked about like, don't have credit card debt and save your money and don't buy a lot of material possessions. So I grew up in a household like that. I think that was also my disposition. And so saving money for me was always relatively easy. Like it was easy for me to be someone who initially in my career cut back and lived below my means. And I think really since I've had kids, it really opened up my eyes to, I actually also have to enjoy some of it.
Right.
And that was the boat thing too. Like, yeah, I look at it and I go, why am I spending all this money? To go? Because I get experiences with my kids and we get to be outside and they're off their screens. And so that experience side of things, having a family has totally changed that for me, where being a middle-aged guy now, I have to actually think about like, yes, I'm still delaying gratification, but I also want to have some gratification now too. So it's definitely way more of a balance for me. And that's the biggest change for me financially over the last, 10 years or so.
I mean, my interpretation of that is that we will pay a ton of money to be cool enough for our kids to still hang out with. I mean, that's
yes,
that's
it is. It's a reason. Yes, it's a reason for them to be around us and give them something to do. And I can already tell my oldest daughter will be 11 in a couple of days here, actually. And I can already feel her turning into a teenager and losing my grip very quickly. So I'm trying to hold on for as long as I can.
Yeah, no, that's fantastic.
I had to make the same shift to spending more than I was comfortable with because of that exact reason. Like as I watch my kids are 16 and almost 13. So I've already watched one sort of slip into teenagerdom. And I have to give him credit. He's not like the most the most stereotypical kid, but he does do a lot of the headphones in, sit in his room thing. So yeah, you do have to end up spending money to get him to hang out with you.
The way that I've looked at it in the past and explained it to people is like, you should like facilitate back and forth between like, it's so painful how much I'm saving and why am I spending this money, to then when you're spending it, you go, oh, it's kind of painful to be spending this money I could be saving. I think you have to kind of go back and forth and have both of those feelings.
Yeah.
I'm like, well, what if I just took all this money I'm saving and did something with it? And on the other hand, well, what if I just saved this? Can you imagine the compound interest? I think you have to go back and forth on those things. And that's like the balance you're trying to strike.
But if you're not exercising those muscles both when you're in your earning and saving years, it's going to be really damn hard when you get to those financial goals and you've atrophied all of your spending muscles to actually derive any pleasure from what you've spent 50 years actually building.
Yeah, that's what I was talking about earlier. It's totally that. You have to give yourself permission. And I think one of the ways to do that is find categories that are important to you and spend on it. You don't have to spend on everything. Like this thing is important to me. I remember when I was young, the thing I said to myself was I kept going to the library to find, because I said I kind of was self-taught and reading all these books on investing. There's all these books that I wanted to read that were never there. And finally I said, you know what? Why am I just not buying these on Amazon? Why am I holding myself back? And I said, anytime I want to buy a book, I'm going to click buy now on Amazon, and I'm not going to hold back and wait. And just, I think giving yourself categories like that to say, I'm always going to go for the nice meal or the nice bottle of wine or whatever it is, whatever it means something to you. I think it's okay to have those categories.
Well,
the other thing too is not to get morbid about it, but like, I think the older you get means you have more friends that are older than you. And that means they're maybe approaching being a retirement age and beyond. And the older you get, you hear more stories about the people who were saving and saving and saving for the things they were going to do in the future. And then something happens, a health issue, someone passes away. And they just can't do those things, right? So I think that's another thing for me that one of the reasons I've sort of changed my view on it is like, I still feel like I'm a young guy, but like I've seen people not that much older than me who just like physically can't do all the things that they wanted to do. So that's the other side of it.
Yeah, enjoy it while you can, right?
Yeah.
Just a side note, one of the things that we've done with our son is my wife and I, the relationship we both have with money coming up was very different than our present situation where we have a pretty nice lifestyle and discretionary disposable income that we can spend. But one of the things that we've really changed is the language that we use around our son when it comes to talking about money. And instead of saying we can't, saying we're not going to, right? We won't. Because I want my son to have healthy relationships about money as he gets older too. So I try to model that a little bit too.
I like that. It is hard in an on-demand world for kids, right? Where they can say, play this song now, play this show now, that they want everything now. And putting some boundaries on it is helpful.
All right, Jeff, what's the next lightning round question here?
All right. So we've talked about a bunch of different things that I think could be construed as advice for individual investors. But Ben, if you had to pick one thing that you think your average investor should be doing differently to get better financial outcomes, what would it be?
I think having a filter in place is very important these days. Again, partly because of the temptation. So Josh Brown, who I work with, always says that being a good advisor is like being a bouncer at a club. Like you're standing behind the rope and saying, nope. Like, I think it's important to define what you won't invest in, right? And that kind of leaves what you will invest in and say like, this strategy might work for you and it might be good for you, but it's just not for me and it's not a fit for my portfolio. So I think having that filter there. And I also think you have to have a filter for your information these days because there's so much information. And it's great if you know where to look between social media and Substacks and podcasts and blogs and all these different avenues you now have to consume content, especially on the markets. If you're following the wrong sources of information, you could break your brain and then totally mess up your portfolio. So I think you have to have a good filter in place to sort through the fire hose of information and understand who it is you're following. And I've seen this stuff over the years of people sending me, hey, what do you think of this guy who says that the dollar is going to crash 90% and the stock market is going to have a worse crash than the Great Depression? And I think if you can filter out some of those sources that have been saying that for years and years and years, that's very helpful.
Well, and I think the deluge of information, if you take that, and it's been compounded by, you were talking earlier about all this increased access we have to so many investing products and the simplicity, all of the filters and the friction on access to these investing products is completely gone. So it's like supercharging our ability to screw things up.
Yes.
You have to develop your own friction. You got to put your own friction back into the process.
That's good. That's good. All right. Last question here. We shared this one with you, so you've had some time to think about it. This is the most important question that I want to hear the answer to. What's a TV show that your colleague Michael Batnick is absolutely wrong about?
Well, he never really watched Seinfeld, which I grew up on a lot. But he also said he didn't really care for The Bear on FX, which I think is one of the better shows of the 2020s. So I'll say that. But his movie tastes are really where we differ, because he watches all these horror movies.
Yeah, that's right. That's right.
He goes to see like a new horror movie every weekend at the theater. And I guess this is what makes a market, though, right? Because markets, it's a lot of the stuff is subjective and taste and preference. And I think it's a lot like investing. You have to find the thing that works for you. He likes horror movies. I'm more of a coming of age kind of guy, and dramas and comedies. And that's where we land. So him and I are like, he's like a trader and I'm a long-term investor when it comes to movies.
That's fantastic. Great. That's such a good way to put it, Ben. So for just the background for those that don't know, Michael Batnick is one of Ben's colleagues at Ritholtz. They co-host the Animal Spirits podcast, and Michael writes the Irrelevant Investor blog, which I also highly encourage people to read. That read Ben's first, and then you can read Michael's after. I think that's right. Now, if Michael was here, I'd be saying the other way around, of course. But
yeah, but he's not. So.
That's exactly right. Well, Ben, unless you have any final thoughts before we wrap this up?
No, I appreciate it. This has been a great conversation.
Yeah, appreciate you coming on. It's been great. Again, Ben Carlson from Ritholtz Wealth Management, and we're going to put it in the podcast description. But check out A Wealth of Common Sense. Go buy his book on Amazon too. It's got the same name, Animal Spirits Podcast. And if you get bored, go check out Batnick's work too. It's reasonably interesting as well. Ben, thanks again for coming on.
Thanks, guys.
Thanks, Ben.
All right, everybody. Remember, we love to share our answers to these hard investing questions. Have great guests like Ben that actually know the answers to those questions, but it's still up to you guys. It's up to you to find your own answers to the questions. You can do it, though. I believe in you. All right, Jeff, we'll see you next time.
See you next time.